Does anybody know what that picture is? I'm going to level set everybody. That's a slide rule. Anybody know what a slide rule is besides you? All right. So when I began my career, that's how I did calculations. I was an electrical engineer. I worked for DuPont for 7 years. And full disclosure, I couldn't make enough money without moving to Brevard, North Carolina, which is right next to Bat Cave, North Carolina. I decided to go to work on Wall Street. I was a treasury broker for 15 years, and then I began ICAP's electronic voice and hybrid platform. So I moved, took my electrical engineering background and put it to work on technology. After 31 years at ICAP, I started a consulting firm. So much to your point earlier, God bless the broken road, right? There's no straight path to all this, and you should really explore all the opportunities. But these are the global regulatory agencies that are now involved in the business that you're involved in. So don't think it's not important. Don't think that market structure doesn't matter. Don't think that what you've learned from the guy sitting next to you or the woman sitting in front of you isn't something that's going to be valuable someday. There are words in Dodd-Frank that I wrote. And I'm proud of that because they didn't really have a sense of what the markets meant and how they operated. But they were responsible to write the laws and the rules that manage our market. So it's very, very important to be aware of the fact that the things that you know and learn are valuable to people outside of your sphere. I want to start with this because I think it's pretty important, and it's a very good background. How many people heard of the flash crash? Right? It's over 5 years ago now. It was a terribly traumatic operation. The SEC and CFTC did a complete analysis of the flash crash. So what exactly happened? And in the analysis, they found out that it all tied down to a single futures contract, the S&P E-mini contract. And then they did the analysis and said, how many people were trading that contract at that time? More than 15,000 traders were trading the S&P E-mini contract at that time. Why is that important? Because it helps you understand market structures. I want you to think about the number of instruments traded, the E-mini contract, and the number of participants. That first month the E-mini contract was traded. The symbol is ES. It was traded by 15,000 people, and it creates this structure, an exchange model. A lot of people trading a small set of instruments. It's a continuous market. It's the equities market. It's the futures market. We're going to take a different view now. We're going to talk about rates. And we're going to look at the number of instruments traded and the number of participants traded the instrument. A rates trader can trade anything they want. Interest rate swaps, U.S. Treasuries, futures contracts, a wide variety of products that help them understand where the rates market is. And how many participants are there? In interest rate swaps, I'd argue that there aren't 15,000, there aren't 1,500, there's not 150. So there's 3 orders of magnitude fewer participants in the marketplace than there were in futures. And they can trade anything they want. That's the OTC model. It's a very, very different model than an exchange. And it's important to understand the difference because you're going to be working in areas that actually will touch on these different markets, and understanding how they trade, when they trade, and how frequently they trade helps you become a better trader. Does anybody recognize what house that is? It's from the King of Queens. Although it's not in Queens, it's in New Jersey, which is what I found out. But I want to talk about this for a minute. I just gave you a very quick summary of different market types. But even within an asset class, it can trade differently. So I want you guys to think differently all the time when you're thinking of things and look for parallels, because parallels help you understand things. We speak in stories because people understand stories. So here's my story. You want to sell that house. It's an average house in Queens. How are you going to sell the house? You might go on Craigslist, Facebook, tell your friends. You're trying to sell a house. You don't want to pay a broker. 4, 5, 6%. It's not necessary. So you try to sell the average house to a large group of participants. What if we're trying to sell this house? That house really is for sale in Washington. It's not mine. you're not going to have strangers knock on your door at night with that house and say, I heard your house is for sale. So you're probably going to go to a broker. You might use somebody like Zillow or Realtor.com or a local real estate broker to weed out maybe some of the people to make sure they're really bona fide buyers of your house. This house. The former owner of this house was mentioned in the last presentation. That's John Corzine's former beach house in the Hamptons. Assuming it's not in receivership, which probably not, that real estate asset certainly isn't going to go on Facebook, not that mode of execution, and they're probably not going to go to a real estate broker to put the house on the market for that form of execution. That's probably going to go to an auction where they want to vet the buyers. They want to make sure that every buyer that raises their hand that wants to buy that house can afford that house, right? And that in that auction environment, we can now see what the real value is. Because I really want it, and he really wants it, and she really wants it, and we see that competition. So that's how I'll get the best price for my house, because it's a very unique property. It's a one-of-a-kind place. And I can't put it on Facebook and expect that I'm going to get the best price. So the point I'm trying to make is that there are several different modes of execution, if you will, even within the same asset class. So don't get locked into one thought that, well, that's just how it trades. There's different ways of trading. Chris White talked a bit about dealers and broker-dealers and their role. And I'm going to go into that in a little more detail, but one of the real roles of the dealer, he alluded to, didn't quite get there, and he probably left it up to me because he knew what I was doing. Paying for immediacy. We're going to play a game, like Chris. You've got a problem. You owe somebody $10,000. They want to get paid in 30 days or they will kill you. Very simple binary deal here, right? I want my money. You don't get my money, you're dead. All you have is that mint 2005 Honda Accord, and that's all you own. That's it. I don't have the $10,000. I can't borrow it. What am I going to do? I'll sell the car. It's easy, right? It's a Honda Accord. Everybody likes Hondas. So you go to think of a dealer, and you start wondering, wait a minute, I'm not going to go that route, right? That guy's sleazy. He's a criminal. I'm not going to use him. I have Kelley Blue Book. I know I can find out what things are worth. So I put my 2005 Honda Accord on Kelley Blue Book. I put all the features. It's low mileage. It's garage kept. It's a great car. I know what I want to sell, and I know it's worth $10,000. I can sell it privately, Craigslist, Facebook, or I can go to a dealer. I will guarantee you the dealer will buy your car. He will give you the immediacy you need. Maybe not at the price you want, but it will be the immediacy you want. So I put this into the Kelley Blue Book estimator to see what would happen. And there it is. Private party range, great. It's $10,306. I'll go sell my car. So I go to my buddy down the street, tell him I'm trying to sell my car. It's worth more than $10,000, but I just want $10,000 for it. No takers. I put it on Craigslist, Facebook. I put it on Autotrader.com. I try several different execution methods. No takers. I can't sell my car. I give up and I go to Kelley Blue Book and I say, listen, I'm going to just sell it to a dealer. What's it worth? And those are the real numbers that came up. This wasn't a corporate bond. It wasn't an emerging market bond. It's a car. But it underscores how markets operate. That dealer is providing immediacy to me. I'm going to go in and they're going to take my car from me and they'll give me cash for it. It's going to cost me over $1,000 for that. More than 10% of the value of my car. I paid for immediacy. Right? So don't think of these markets that we're operating as anything strange or as anything unique. What happens on Wall Street happens every single day in everything else we do. It's a function of buying and selling. It's a function of finding value. One of the first things I was taught when I got into fixed income was nothing has value in and of itself. Now, back in the spring, early spring, the euro was collapsing, oil was collapsing, and Tom Kane on Bloomberg said, this is unbelievable. The dollar is rallying and oil is crashing. And I sat there and I said, yeah, because oil is dollars per barrel. You're measuring oil against dollars. So why wouldn't they go in those two different directions, right? The dollar couldn't crash and oil couldn't crash because oil is measured against dollars. Everything's got value relative to something else. For those of you that think interest rates don't belong here, that these are at historical lows, that's the last 70 years of the 10-year yield. The anomaly isn't now. The anomaly was in the 70s, 80s, and early 90s. Right? We had a 30-year bull market in fixed income rates. That was the anomaly. These rates here are probably normal rates. I can go back to the 1700s, and you'll roughly see 4 or 5%, 3, 4% as interest rates. The anomaly happened during the 70s and 80s. The bars next to it are the number of U.S. primary dealers. So these are the dealers that have access to the Fed wire. They have to buy a certain percentage of bonds in Treasury auctions. And I think it's an interesting parallel that as rates began to come down through mergers, through people giving up their dealerships, the number of dealers have gone down. Paying for immediacy. Is there a relationship between fewer dealers and Danny DeVito charging you less money, paying you less money for your car? There was another flash crash, happened last October. These are charts from the CFTC's bid and offer and price on that day. The red and green lines are the bid and offer depth, so the number of buy and sell orders. The blue line is price. It looks like there was a catastrophe at 8:30. All the bids and offers left the market. There wasn't. There's an economic number coming out, and before numbers come out, people take their orders out of the market. They want to see what the number looks like first. It's not a disaster. It's not a collapse. It's the way people trade. The number came out. Prices started to rise. People started to come back into the market. For some reason, prices started to escalate rapidly. What do people naturally do? They pull them orders out of the market. They want to see what's going on. This is a great image for you guys to think of in terms of how people trade. Now, for humans, it's hard to keep up with that. Algorithms can actually begin anticipating these moves, and they may exacerbate these moves. They may make them worse than they really would have been with just people, but the reality is that's typical trading activity. There's nothing really, really unusual about that. I talked about dealers, and I think this might be on my last slide, but it's something I hope generates some discussion with you guys, because I think most of you probably work at broker-dealers. There's an index. Are you guys familiar with the VIX? Right? They call it the panic index or the fright index in stocks. In fixed income, it's called MOVE. It's an index by Merrill Lynch. It's the Markets Option Volatility Estimate. And it's basically the VIX for fixed income. This chart takes the number of dealer orders, Treasury transactions, divided by the MOVE index. So the bigger the denominator, get your slide rules out, the bigger the denominator, the more that number drops down. Look at the slope of the drop in that first bar. So as volatility went up, dealer transactions dropped. We know what that was. That was the financial crisis of 2008. We all lived it. We all experienced it. Some of you were in high school, but we experienced it. Maybe grammar school. We experienced it. We know what happened. But when you look at the analysis and you say, wait a minute, that angle, the slope of that line repeated in 2011. What was the crisis in 2011? I don't think there was one. What was it? That probably happened in 2010, right? That probably happened closer to the crisis. 2012, even a more severe dropped. 2013 and 2015, again, this is just showing that as we see increases in volatility, the dealers themselves are tending to back away from the market. It's creating a void. That's a problem you guys are going to solve. That's a problem that's not going to go away in the next year or two. It's a problem that's an indication of a shift in market structure. What I'm hoping to leave you with is this. Whether you're selling a house, selling your car, buying a house, buying a bond, doing an equity trade, doing a futures trade, understanding how markets work is a foundational necessity for you to be successful. You're going to learn from other people. You're going to sit next to somebody that you say, I like the way she works. I like the way she comes up with ideas. you'll pick different skills and different capabilities up from different people you work with. But don't try to mimic them. You're going to build your own. You're going to have your own case. When I left engineering to go to Wall Street, I was the anomaly. There weren't any other engineers working at Garban, the company I worked at the time. Today, my engineering school has a quantitative finance program. My engineering school, Stevens Tech, has a graduate program in financial engineering. 93% of Stevens graduates have jobs before they graduate. By September, 99% are either in graduate school or working. Nearly 30% of the graduates at Stevens last year were hired by financial services companies. Right? So the industry is more analytical. The industry is clearly looking for people that can think differently about how these markets work and where the opportunities are. Don't be afraid of taking courses in that. Don't be afraid of asking people about it. And don't stop your education. After you graduate and when you are working, don't be afraid of taking classes at night, going towards a master's. One thing I learned as an electrical engineer was the kids coming out of school 4 years after I graduated knew more than I did. So my experience didn't matter as much as what they learned. And that's happening today at even a more accelerated rate. Right? The things that you know that we've never learned, you're going to put to better use than we could possibly ever do. Thanks, everybody.